pandemic. So the last Bank of Canada decrease to the overnight lending rate was on March 27th. And what we found is that the Big Six followed suit by reducing their prime lending rate. So we are seeing prime currently sitting at 2.45%. So what does this mean? So anybody sitting with a variable rate immediately saw a decline in their overall interest rate because the prime lending rate had also decreased. But what was interesting to see is the fixed rates actually increased. And what lenders were offering in terms of their overall discount on variable rates for clients seeking a new mortgage, those actually rose in immediate response to the March 27th announcement. So that was a little perplexing to clients because they were automatically assuming that with the Bank of Canada announcement that they would immediately be benefiting from these lower rates if they were looking to secure a new mortgage. And the reason that the banks had actually responded with this temporary increase to rates was really just due to liquidity pressure, because what we also saw as a response to the current pandemic is that on March 18th, the big banks and the Government of Canada announced the mortgage deferral program. So that it's important to note that the deferral program is something that's being offered by the lenders directly. So these deferred mortgages are sitting on our bank's balance sheets. And in the end, the banks all, report to their shareholders. So there was some liquidity pressure with less people working, less deposits going into, your bank accounts, people deferring their mortgages. There was some liquidity pressure. And the one benefit of being here in Canada is that our regulatory bodies are quite strict with our Big Six and our lenders to ensure that they're maintaining a certain level of liquidity. So what we immediately saw was the temporary increase to interest rates on the fixed rate mortgage side. What's interesting to note is over the last week, we have seen those rates come down. And rates currently, and I'll just kind of reference for the moment, on a 5-year variable, we're offering rates as low as 2.25%. On a 5-year high ratio mortgage, we're doing as low as 2.59 again, which is where we were sitting pre-pandemic and pre-COVID. On a conventional mortgage, we're seeing rates as low as 2.69 and 2.79 on a 30-year amortization. So very comparably to where we were sitting pre-COVID. But I also do feel that as the economy continues to, stabilize, and we see, a little bit more of a concrete sort of date as to when the economy will kind of, restart, and we'll see that sort of stability come into play, the chances are that the rates will continue to dip. Those fixed rates will continue to dip.
Okay, great. That's really interesting. So it's staying on with the deferrals too. I know you brought up the mortgage deferrals, of course. Mm-hmm. One of the questions we actually received was regarding the mortgage deferrals. Maybe if you can kind of go into who should apply, but also would those mortgage deferrals impact the applicant's credit score?
Okay, absolutely. So the two key things to note is when the announcement was made that this would be a program that would be available, the way it was communicated through the media is that it's a blanket offering for all. And it's so important to note that this program is being offered for individuals in need. So if you're a household that has, experienced a temporary layoff and you're having some short-term difficulties in meeting your mortgage payments, the deferral program can be a great temporary solution. So it's important for clients and consumers to understand that this isn't a long-term fix, that the interest is actually being added to their existing mortgage balance. So this is a short-term solution. Is it a good solution? Absolutely. If you're experiencing a temporary layoff and you're expected to return to work post-pandemic, and you're going to be able to continue to carry your obligations, yes, the deferral program does offer a temporary solution to a potential client or a consumer that is carrying a mortgage. However, it is important to understand that it is temporary, that you are still accruing interest, and that gets added to your existing mortgage balance. So through this 6-month deferral program, your balance is actually increasing, and you are now, you are being charged that interest payment. It's just not being taken up front, but added to the balance due. The other key piece is that it's important for clients to confirm with their mortgage lender that this is going to be reported as a deferral and not a missed payment to to the credit reporting agency. Now, I don't think anybody was completely prepared to handle the magnitude of administration that's going to follow with this current situation. So it's important that clients ask the right questions. When you're connecting with your lender, ensure that you have the name of the person you're speaking to. Ask for a reference number. If you can get confirmation of the approval for the deferral program through an email, we're recommending that. Source as much information as you can so that should there be an error and should a potential missed payment or deferred payment report as an error on the credit report, that it can be mitigated and corrected easily. And I have confidence that, Equifax and TransUnion and our reporting agencies will be working diligently with clients to rectify any errors that may take place. But it's inevitable to some degree.
That's great. Okay, awesome. We'll move to the next question. This question is about refinancing. Specifically, should people be taking advantage and securing home equity lines of credit?
So this is very dependent on the client's specific, unique situation. And this is where I will say that the role of a mortgage broker has really shifted from somebody that's, transactional and just meeting a client's sort of financial needs and requirements to really helping assess what might be best. So when looking at, securing, for example, doing a refinance of your existing mortgage, it's important to also evaluate the costs associated with the refinance. Will there be a penalty? What will be the interest savings? And also connecting with the client to understand if there's an opportunity to restructure existing debt to help lower their monthly obligations, to help position them in a more comfortable position. It's also important for clients to understand that they may also need some additional cash in hand to kind of be comfortable over the next, 4 to 6 months to help kind of support with this, with this change. So again, it's very specific to the client situation. A HELOC can be a great solution with the prime lending rate sitting as low as it is. The obligations on a home equity line of credit are usually interest only. So that too can be a great sort of solution, but the key piece with qualifying for a HELOC is that the stress test used to qualify for a HELOC sits a little higher. So if a client has been impacted by the pandemic with a loss of employment or a change in their income, they may have some trouble qualifying for that product. But this is where we can connect with the client to individually assess what might be better, a refinance or a HELOC. But it is contingent still on the income being generated by that household to be able to qualify for those products. So from a qualification perspective, nothing has changed with the lenders. We need to be able to prove the necessary income to ensure that the qualification is doable.
Great. And in terms of qualification, we just had a question come in as well. I know we spoke about this prior, me and you. How are the banks approving mortgages now that there's so much uncertainty with jobs? And is it getting any tougher?
So a good mortgage broker is a business case builder. So it requires us asking a number of additional questions that we're not used to connecting with clients on. So all documentation needs to be provided up front. So lenders want to see a letter of employment dated within 14 days of the application. They want to see a current dated pay stub, the most recent pay stub. They want to understand what industry your clients are working in. We need to build a reasonability, sort of do some additional due diligence and research to be able to prove continuance of income. If the client is self-employed, they want to understand how have the services being offered by our applicants, how have they shifted to accommodate our new reality of working virtually. I was sharing a story where I had a music teacher that, was teaching at the universities and was self-employed part-time with private clients, and we were able to provide a website, and she's moved her services online. So providing lenders with the full scope of the story and as much detail and documentation up front is really helping to facilitate quick approvals. But again, this is where the role of a mortgage broker is really to build that business case and present it strongly and present all information and documentation up front at the time of securing.
Yeah. So which to me is one of the reasons why you don't differentiate on the price.
Oh, did that come from?
That cut out there for a bit.
Oh, I didn't catch who actually asked that. If anybody, or if was that somebody's monitor maybe? Well, if anybody has a question, please feel free to repeat.
I understand, but if you're actually talking about the beverage, not the intoxicant, then the liquid is what's worth 10 bucks. And the intoxicant is just the intoxicant.
Oh,
I didn't quite catch that. Did you catch that, Rakhee?
No, would it be possible to populate that into the chat box so that I can ensure that I'm able to address the question?
Okay, great. Well, while we wait for that to come into text, we can kind of go into the next question. So,
Sorry.
is it coming in?
I'm so sorry. Just 1 second. 1 second. Just give me one quick moment. 1 quick second.
No problem. Hey, that's today's age.
hello.
Hi, how are you?
Good, thank you. I just joined you. Sorry I'm late.
Oh, no problem.
Do you want us to mute our mics so you
No.
don't hear any background noise? No?
Maybe while we're talking, you can go on mute, but please feel free to ask any questions. Did you happen to have any
Great.
questions?
I do, actually. I just realized the other day that my mortgage is up for renewal in August. So I was very excited about that. And for probably, oh goodness, maybe 20 years, we've had a variable mortgage. And now I'm considering locking into fixed, but I'm not really sure. I don't know what to do, to be honest with you.
Okay, great question, especially today. So I'm going to wait for Rakhee to jump on in because I know that.
Sure.
Or do you have, it looks like you're on the edge of your seat.
Hey, yeah, we'll just wait for Rakhee to come back in for sure, because she'll have some great insight on that. Oh, here's here. She's coming back.
5%. So you're not getting a 20 milligram dose, you're getting a 1 milligram dose.
There you are.
I'm back.
Okay. Rakhee, we have Helen on the line. She had some questions.
Sure.
Hello. Yes, my mortgage is coming up for renewal in August, and we've always typically had a open variable mortgage rate, but our last 5 years was a variable but closed. So now I'm really considering locking in 5-year closed. And I'm looking at rates and they're very good, but I know my variable rate is even lower, but we don't have a crystal ball to see what will happen in a few years from now. So I'm just not sure what to do.
So the key piece is really focusing on who you're working with. So my recommendation is to encourage the variable closed. That's where you're going to be able to secure the largest discount to prime, which I think will help you ensure that you're securing the lowest possible interest rate. The other advantage is that if you're working with a broker, we would reach out to you, if there was a potential upcoming increase to rate. And what we're likely to see is that as things start to stabilize, we are expected to see the fixed rates drop. So at that time, we would reconnect with clients and have that conversation. There is no cost associated with moving from a variable product to a fixed rate term, as long as you're working with the same lender. So I think that would give you an excellent option. I definitely would encourage a 5-year variable closed mortgage, and then just being proactive of monitoring the environment and seeing where fixed rates are seeing. And as things start to stabilize, now our calls with our economists and the information we're receiving is that chances are that we will likely see the Bank of Canada keep the overnight lending rate where it is for at least a year. And that's just to ensure that we continue to focus on stimulating the economy and keeping things as stable as possible. And there are conversations that we may not see a change for up to 5 years. So
okay.
in your home, and that you just continue to be proactive and monitor, I would say that you're probably safe for at least 2 to 3 years, but it doesn't hurt to continue to monitor the movement of the fixed rates. And if the fixed rates start to drop as things start to stabilize, you could very easily then lock in, and we can reassess your situation. Are you still continuing to want to stay in your home? Is there a potential change that you should consider? And at that point, we can always look at maybe a shorter term on a fixed rate product.
Okay. That sounds a little more reassuring. All right.
Awesome.
And maybe
how-
we can talk afterwards, or I can get your contact information.
Sure, I'd be happy to share that.
Great.
Yeah, we can post Rakee's contact info in the chat box for anyone that has specific mortgage questions. She's more than happy to reach out and chat with you, of course.
Great.
Perfect.
Rakhee, I have a question, and that is, as a realtor, we noticed even before this went down, actually I would say we noticed it in the fall of last year, the banks were getting really tough on the appraisals.
Mm-hmm.
We were getting properties appraising lower than what we were selling them for. Have you noticed anything like that going on now?
I think highway is the best way to go.
I have, in the sense that we're now receiving ranges, right? Because we're being a little bit more sensitive to not having appraisers go into properties. So appraisers are now providing ranges in their reports. They're not assigning a specific value. So as long as the purchase price or the refinance value assigned on an application falls within that range, and that range is based on data that they're able to pull within the 90-day, I almost feel like it's created a little bit of a loophole where we're able to get certain things in without necessarily a full appraisal. I've had some clients come back to me and say, well, there's a finished basement. I want, why am I not on the higher end of the range? And unfortunately, given the current pandemic, lenders have had to modify their requirements and are simply using recent data in the last 90 days to provide a range. And as long as the purchase price or the refinance value assigned falls within that range, it kind of is auto approved. So I think that that's almost provided a little bit of a benefit.
Yeah.
Where the downside is, I'm finding that outside of the immediate city, what we're seeing is the sliding scale, where properties, above 1.2 technically require that larger down payment. Usually, or typically, given most properties, in the city of Toronto do sit well above that 1.2, depending on, neighborhood. It's very common to see properties above that 1.2 price point, where we were very easily able to secure sliding scale where we could get, up to 80% of the purchase price approved very easily. We're now finding that lenders are being a little bit more resistant. They want to ensure that clients have a little bit of a secure fallback position, or that they're putting a little bit more down. And outside of the immediate GTA, we are finding that lenders aren't willing to do those very quick approvals that we're used to. They want to see a little bit more skin in the game. They want to see a little bit more going down as a down payment for that additional security. So we're starting to see that shift now.
Yeah. Okay.
Great. Awesome. And okay, great. So would you want to kind of talk about the recent changes that Scotia has done, and what are your thoughts, and will other banks follow?
So all it takes is one. Right? So after the announcement on Friday, March 27th, on that Saturday morning, I had my team actually in the office working, renewing pre-approvals, and that was because Scotia was the first lender to increase rates. Fixed rates went up on that Saturday, on the 28th, because Scotiabank was the first bank to kind of lead with that change, and the others followed. So 2 weeks ago, Scotia offers a few different sort of variances in terms of products, such as home equity lines of credit and step products to clients, so that they can tap into that additional equity. And what they've done is 2 weeks ago, they changed policy where you're no longer allowed to purchase investment properties from borrowed funds. So they were no longer approving these step products and these home equity lines of credit if the client's intention was to use those funds towards purchasing an investment property. So we're likely to continue to see this with applications that we've recently put through. For clients looking to buy investment properties, lenders do want to see this coming from actual savings. They don't want to see clients over leveraged. So this is something that we're definitely seeing. We're also seeing lenders, starting to change policies on the qualification standards for HELOCs as well. We're finding that they're doing some additional due diligence, and this is just because they're kind of just thinking ahead. As we head into September, when we're hoping things revert back to our new normal, that a number of these sort of programs offered by the government will begin to retract, like the ERB will go away, and clients are then going to need to likely rely on these additional sort of options as home equity lines of credit and tapping into equity to kind of make ends meet if there are any impacts to employment. So at that point, I think they're thinking ahead, and they're wondering if, maybe we will start to see, chances are we'll likely start to see tightening of policy around securing these types of products. So this might be a great opportunity for a client to look at, maybe, putting in an application if they're actively still employed and there is that continuance of income. It may be something to consider now. But yeah, I know we do anticipate things getting a little bit more challenged and a little bit more difficult from a qualification perspective. And from a lender's perspective, they just want to ensure that, this could add added strain to their balance sheets and their books as well if clients continue to over leverage themselves and tap into this equity.
Rakhee, would it be fair to say then that we may not really know people's financial situations based on all of this until September, October, when deferment's over, people's subsidies are over, that's when I think maybe we might get another hit of reality?
Absolutely. We have to remember we have these mortgage deferral programs in place. The Big Six have also made accommodations in clients meeting their lines of credit payments, their credit card payments. Insurance companies have made accommodation right across the board. Utility companies have made accommodations as well. So I don't think we're seeing the full picture right now. And long-term sort of impact to people's employment situations is where I think once that starts to evolve and we start to kind of come into our new reality, I don't think things are going to revert back to what we remember. I think it's going to be definitely a new reality. Until we have that clearly defined, I don't think we'll have sort of a full overview on the overall impact.
Yeah.
Wow, that's really interesting. So, sorry, just to go back, so you mentioned Scotia, because I know that they had a few great products where people were using the equity in their home to buy their. So you're saying that they're no longer able to use the equity in their home.
Not to purchase an investment. Not to purchase an investment.
Investment. Wow. Okay.
We still have, a couple of monolines if the purchase price on the new property is below $1 million, which again limits, we have a solution there. So as mortgage brokers, we take part of what we can do, not, we know where the obstacles are, and then we look at all alternative lenders that may still consider, and we do have one insured lender that will still consider that. But that's always subject to change. We're finding policies are changing on us on a moment-to-moment basis.
How are the lenders with straight investments? Let's say I'm buying a student housing. I've got positive cash flow. I've got my 25%. How's that going? So
through our channel, and Jordan will be able to provide some additional details on this, but securing a mortgage through the broker channel for student housing isn't necessarily an option we have access to. If it is an investment property though, and the client, yes, if you have an investment property and we can show that there is market rent, they want a market rent report, so they're not just going to rely on a lease. They want to ensure that market rent reports will validate a certain level of income coming in. And as long as the down payment is coming from savings, right now that's a non-issue. That's an approval we can secure without concern.
May I ask another question, please? Yes. My son is recently looking into getting a condo. Can you just review the criteria for a first-time buyer?
So for a first-time home buyer or any individual looking to purchase a property with the intention of occupying that property as their primary residence, the minimum down payment requirements are 5% of the first $500,000 and 10% of anything above, up to a maximum price point of $999,000. Once we hit that $1 million mark, we must put 20% as the down payment. But below that, you can put, so for example, if the purchase price is 500, then it's 25,000. As we go up to 600,000, your minimum down payment would be an extra 10,000, 10%, an extra 100 for 35,000. So as a first-time home buyer, you're able then to utilize the minimum down payment. We would need to ensure income and just assess what the down payment is to establish what that mortgage qualification would be on a condo property.
Great, thank you.
No, Rakhee, just to build off that, we were speaking about certain incentives in the situation right now for first-time home buyers, and kind of how the situation's kind of working for the first-time home buyers.
The incentive program?
No, I know we mentioned that there were recently introduced incentives for first-time buyers regarding mortgages.
So there was a incentive that was offered through the federal government, which was a first-time homebuyer sort of. They were doing an equity loan basically, where they would give you up to 5% of a resale or 10% of a new construction as an equity, sort of an interest-free loan, but they would have interest in the property. What we've personally found is I haven't executed any of these transactions because it limits you to a price point of $560,000 on a freehold and $430,000 on a condo. So personally, we found it very challenging for clients to be able to source properties at those price ranges. So personally, I feel it's a better suited product for, individuals looking outside of even the province of Ontario or further sort of, on the outskirts. But it isn't a program that I've seen successfully tapped into for first-time home buyers.
But if somebody found a place for $450,
and as well, there's still the other incentives, the credit on the land transfer tax for first-time home buyers. They can pull from RSPs to use towards down payment, tax credits on returns. Like there's still a lot of those things as well, which help a lot of first-time buyers.
For sure. There's absolutely the land transfer rebates apply directly at the lawyer's office. So it has that immediate impact on reducing your overall sort of closing costs on making a purchase. And then the other piece is that you can take up to $35,000 from your RSPs and place that as a down payment on a new purchase. So there are a few different sort of options available to first-time home buyers.
Okay, great. And sorry.
Sorry, I just wanted to go back to Aura's point about, if a client does find that property of $450,000, that incentive program, what it does is it helps reduce the client's overall monthly payment. So it doesn't help them qualify for more, but that could reduce their monthly payment by, let's say, $200. So on, let's say 10%, it's a new pre-construction, $450K. Let's just say that's 10%, and the client is, now receives this first-time home buyer, loan from the government for $45,000. That can absolutely lower the client's monthly obligations and be helpful in helping them sort of make that transition from renting to buying, right?
Yeah.
So that.
No, I think it's exciting. If you don't have to bring the government in to be your business partner, I would.
Part ownership.
Or it's not. But if it's the difference of buying a place or not buying a place, that's a wonderful option.
Yeah, and those $200 off your monthly payment could be huge for sure.
And I can't help but again go back to, well, I know there's very little on the market. I know we haven't seen a real drop in prices yet. We know ourselves just from our team, and Rakhee, I think you've found it as well, a few people that were gunning to buy have to pull back, job insecurity, other commitments, life change. I think we're going to feel a little pullback on all the prices right across the board, and maybe allow some of our first-time buyers to get in without all the bidding wars and stuff. So there's a positive side.
She's on mute. Oh.
Can you say that again? We missed it.
I'm finding that we've had a number of my first-time home buyers that were defeated in January and February just due to the immense demand and those, multiple bid situations where they were in competition, use the opportunity to secure homes and condos. I have found they're very, because they had spent so much time looking, a few of them knew exactly which buildings they wanted to be, which units, which layouts they were interested in. I actually had a number of clients even buy property sight unseen with a condition to view the property prior to the conditions being satisfied. So it's interesting how some clients have actually, that have the continuation of income and employment, that are able to use the opportunity to get into the market. And where we've engaged in conversations about potential sort of changes to market value, because they're looking to make these purchases, with the intention of living in these homes long term, they're confident that the properties are going to rebound. And the conversation that we usually often have is that this is probably going to be a blip versus a long-term sort of, permanent impact. I think we're fortunate enough, the Toronto and the GTA market will likely rebound quickly, and those values are likely to come back. And I think that also speaks to why we're seeing that lower inventory, because I think people are very confident in what they feel their homes are worth. And if they can't get that value, then they're just going to continue to sit and wait for things to kind of rebound. But those that are motivated to potentially sell now, or may have made a purchase because we were sitting in a buyer's market before, I think this is presented opportunity for a number of my first-time home buyers to actually secure purchases.
Great move up market too. Great move up market.
And what's also interesting is a number of clients that I had, getting married this summer have now made the decision to get their deposits back and buy homes instead of, because the timeline's uncertain. So they're like, we might as well, take this to buying our home versus putting it up.
That's a good point. Really good point. And especially for certain markets that were really favored for first-time buyers, it was, a couple of weeks before this happened, it was incredible in terms of the bidding wars, the week by week increases. It was insane, and it's really like overwhelming for your first time buyers. And now we're at a point where people are kind of, maybe prices are going to go down, maybe I'll be able to get a deal. But if, like you said, if you are thinking about real estate as a place you're going to be living in for an extended period of time, you have a period of time right now that there's very little competition. You can actually go inside that, or you can virtually go inside the home, sleep on it. You can actually sleep on it for and it gives you that ability to really, just less competition. That's great.
Yeah.
That's a great point.
Yeah.
Awesome. Great. So the last one I have here is a hypothetical, but it says, if I were to lose my home because of COVID and my home would be closing coming up, would I still qualify for the mortgage?
Oh, like if you lost your job?
Yeah.
From COVID and your home is closing. Does that make sense, Rakhee?
Yes, it does. So this is where it's a little heartbreaking. If you entered into a purchase before March 25th and income documents were provided and conditions were sent, like you've sent the paperwork over to a lender, the lenders opted to just not revisit the file from an income standpoint, and those files are going to close with no issue. And that was just an accommodation that we found was being offered by all lenders on all applications. However, it was contingent on the information being provided. So if it was post March 25th that the broker is sending in documents, or client is sending in documents, then it is subject to re-review, and income needs to be in place in order to ensure that mortgage fund. So there's got to be that continuance of income. And if there isn't, then we're seeing family members coming in as co-signers. Or again, as mortgage brokers, we're business case builders. I was able to get a successful mortgage to close. Client was temporarily laid off, but they had a strong sort of asset portfolio, which we provided statements on. They had strong liquidity in their bank accounts. And we were able to get a letter from the employer confirming that this was a short-term layoff, and that they expected to rebound quickly, and that the position would be made available to this applicant. So again, we've been able to work our magic a little bit on certain specific situations where we were able to build the business case and provide sort of documentation to back it up. But generally speaking, clients looking to close on a mortgage need to ensure that we're working on alternative sources if they've experienced a loss in income. It's just something that we're seeing right across the board with all lenders. They need to ensure clients can make their payments.
I've noticed on MLS, not a lot, but I have noticed a few properties come back to market that we had seen sold. They're coming back to MLS and we can see it's the same seller from a few months ago. Not a ton, but I've seen a couple.
So we're just starting to see that. It's difficult and challenging. We've had a couple of clients that have had to, where we've had to call the realtor and say, I'm just going to give you a heads up. We're going to, we haven't been able to successfully find an alternative co-signer or co-applicant, and maybe we want to delay closing or revisit.
Mm-hmm. Okay.
Well, we have COVID clauses that now go into every offer.
Yeah. Yeah. Great. Well, Rakhee, this was amazing. Thank you so much. If anybody has any questions, please feel free to unmute and ask away. But if not, on behalf of everybody, that was amazing. Thank you so much. And yeah, we look forward to keeping in touch as things develop, of course.
Thank you.
Thank you.
Everybody, Rakhee's information is down below if everybody just wants to go there and check it out. If you do happen to have any questions, her and her team are absolutely amazing, and you'd be in very, very good hands, of course.
Yeah.
Thank you. Look forward to hearing from you.
Thanks,
Thank
everyone.
you.
Always feel free to reach out with any questions to the team.
Thanks, Sora. Thanks for the invite.
Thanks,
Is there any
Helen.
other questions for the team
Thanks.
before we, or just before we close it off? Is there any other questions for the team as well? I know Rakhee's gone, but if there's any other real estate questions, feel free to unmute yourself or type a message in the box before we end the chat.
Yeah.
All good here. Thank you.
All good. Have a great night,
Perfect.
everyone. Stay safe. Stay
Bye.
happy.
See you all next week.
Bye-bye.
Bye.
Oh.
Oh. Oh, Natik, I think you're muted. Let's unmute. Hey, Natik, did you have
I will call you back, okay? So I had a question about HELOC account, if she works with HELOC account, and which bank provides the HELOC account. So that's important for me too. I'm a real estate investor, so I'm trying to actually increase my portfolio. And I heard about some options banking taking towards to limit my options. So I'm looking for a leverage to go into mortgage even more deeper. So HELOC, yeah, it's my interest because I have a lot of equity, and right now we cannot use equity to be qualified for another mortgage. But I like to use my current dynamic cash against my mortgage and have some financial advantage of it, and HELOC gives it. But my Royal Bank, it's not so flexible. So maybe a person in the Royal Bank is not educated, maybe not, I don't know. So I'm looking for options or a person who can help me to set up HELOC account and for me to utilize my current equity and current situation.
Sure. And that's definitely something, what we can do is we can have Rakhee reach out to you directly, and she'd be able to have a chat with you about that, of which providers might be best for that, and what the options are based on your specific situation.
Nathan, is it okay if we have Rakhee give you a call?
Yeah, I was about to take her contacts from the screen to call her and to talk to her. By speed of reaction on the question, it looks like she is very educated in this field and she is very experienced. So, so definitely she knows what she's talking about, and this is very rare. So I'm impressed. And so whatever you're doing, guys, is great. So first of all, let me appreciate that first, okay? So this kind of conference calls on the subject, which actually now worry a lot of people. So it's a great experience. So I wish this kind of conference calls happens weekly. If it's possible, of course. You have a different job too, right? So it's not just entertain us. So, but it's a great experience. I really enjoyed it. So I had a lot of questions about second mortgages, COVID, because I have 6-7 second mortgages, and some of them affected, and also some small nuances. But I didn't want to take time of people here, so because they came for different purpose and different topics, maybe. So, and I didn't vocalize it, but it's great. So definitely I'm gonna call her, sure. Is it today? I don't think so. She is busy, maybe. So she had a great conference call, and maybe she has a different job. So I will reach her and ask her what's a convenient time if I can call her and have a few minutes. I guess we will talk a little bit further to see if it comes out with business relationship. Then I'm great. I'm very happy. If it doesn't, then I will have her for my references in future situation when I'm buying. So I like bully offers. So so for bully offers, you need to have this kind of people on a very short call, right? Yeah, that's it.
Thank you.
Thank
Great.
you too.
Thanks, Nathan.
Thank you. Bye-bye. Thank you.
Does anyone else have any other questions before we end the call? We're just about out of time. You can either unmute yourself and ask, or you can type it in the chat box. If not, I guess we'll call it a day.
I see Shelly and Jack joined. I just want to give a little shout out. Thanks for coming by. Good to see you guys here.
Sorry,
Thank you. Have a nice day, guys. Thank you.
Thanks again.
Okay. Guess that's it. We'll end the meeting then. Thanks for coming, everyone.
Okay, thanks everyone. See you next week.
Bye.